Only 3 presidents in history have dared to do this. Is it politically motivated? Economically motivated? We'll talk about the reasons behind President Trump's unheard-of move and why it's probably too late. Plus, tonight's show is brought to you by CyberCatch Holdings. You can find them on the TSXV under symbol CYBE and on the OTCQB under symbol CYBHF. And they're a cybersecurity innovator delivering an AI-powered SaaS platform for continuous compliance and risk mitigation. And their stock just held the bottom of a rising channel, setting up a potential explosive move to the upside. This is one trade you don't want to miss. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now, let's turn to Bloomberg, where we find out that the President of the United States is setting up a showdown with the Chairman of the Federal Reserve. As Trump to tour Fed construction site after criticizing Powell. Now, I want you to understand this isn't about the actual construction project. It's not about the fact that Fed's spending $2.5 billion to renovate its headquarters. It's not about the fact that those costs are being overrun. It's not even about the details of it. It's all about the economy. Let's take a deeper look. Because in recent days, Trump has said he doesn't plan to fire Fed Chair Powell before the end of his term, but has not fully disclosed the door to removing the central bank head over his handling of the Fed's $2.5 billion renovation project. And there's a very clear reason behind this, because presidents do not have the authority to remove a Fed chair from office. Keep in mind, a Fed chair is appointed by a president. They actually work for Congress. In this case, he could only get rid of him for something like fraud. That's the reason behind this, because when we start to look at the economy right now, it's heading in the wrong direction. And you can think about what's happened recently. We got the tax cuts, but it didn't really change things. The trade war looks like it's coming to an end. The stock market's at all-time highs, and yet what are we seeing in consumption and demand? They're continuing to go down. And maybe a rate cut would make a difference. The problem is right now, we need anything to move the needle, and so far, absolutely nothing is working. Because removing a sitting Fed chair threatens around markets by undermining the long-standing norms surrounding the independence and autonomy of the central bank. And Wall Street, this is the last thing they want. They do not want to see a Fed chief removed, because the belief around the world is that central banks need to remain independent. And if we didn't have them, well, inflation would run out of control because governments would endlessly print money. So what you see here from the investment community is they absolutely want Fed Chair Powell to stay in place till the end of his term. If he is removed, you're going to watch. Inflation expectations are going to surge, and the markets are going to come completely unhinged. And for months, Powell has been under fire from Trump and his allies for leading the Fed and holding fast on interest rates, declining to continue last year's reductions due to concern over the potential inflationary impact of the administration's tariff hikes. So you can understand why President Trump wants to see rates go down. He wants to spur growth in the economy, and so far nothing's working. And what he wants to see is a housing market turn around. He wants to see people going out and buying cars, and he wants to see the cost of money, what's causing stress on households, and that is their credit card minimum payments. He wants them to go down. The problem I see right now is I think it's way too late. But something it's not too late for is for you to get in on this next big trade for our stock, for our sponsor today's show, CyberCatch Holdings. Again, you can find them on the TSXV under symbol CYBE and on the OTCQB under symbol CYBHF. And here you can see the stock just held the bottom end of its rising channel, setting up for an explosive move higher. Again, stay tuned to the end of the show or check out the pinned comment or description for more information. Because let's talk about inflation expectations. And again, the market's view is if it wasn't for central banks, inflation would run out of control. And this has everything to do with the fact that central bankers have convinced the world that monetary policy, even though I don't believe it works, well, they believe it works with a lag. Let's take a look at the evidence, because it's clear, based on the Fed's view, it does, but there's a whole nother problem with this. Let's go back to the late 1980s. You see the federal funds rate in blue on the rise along with inflation. That's shown in red. And what happens once the Fed gets rates into restrictive territory? Next thing you know, not only does the economy fall into a recession, but you see inflation comes crumbling down. In fact, we see that dynamic every cycle here with a lag. A rise in rates leads to a reduction in demand, and that means consumer prices do indeed come down. The problem is it brings a recession nearly every time. And that's the issue we're facing right now. As the Fed says, look, we need to keep rates in restrictive territory. We need inflation to keep coming down. The problem is we're running the risk of heading into a recession. Again, you look at the trajectory of the economy, it's continuing to slow here. So far, nothing's worked. So the real question is, would interest rates have a real effect on the economy? Well, I don't think it's going to have quite the effect that everyone's hoping they would. Because when we look at consumers, they're struggling with high mortgage costs, high car loan costs, and credit card payments. But when we look at the federal funds rate shown in blue against commercial bank interest rate on credit cards in red, you can see that the banks don't necessarily give a lot of relief to their borrowers just because the Fed's cutting rates. And we can see that happening throughout every cycle here. So the notion that if the Fed were to cut rates, that suddenly people would run out and buy a home or a car, or the fact they'd come out and just spend money on the discretionary side of the economy because the minimum payment on their credit card went down, well, there's no real evidence to support that. And that's the real issue here, because when we look at the economy, it comes down to one key thing. It's about the labor market, and it's about demand. And we got some new updates on the labor market. Let's take a look at that, and then we're going to take a look at what's going on in the economy, because the evidence is clear. It's heading in the wrong direction. As U.S. jobless claims now fall for the 6th week, this is the lowest since mid-April. And the good news is initial claims decreased by 4,000 to 270,000 the week ending July 19th. And this is clear evidence that employers want to hold on to their employees. And this, again, is a good sign for the economy, particularly those who have jobs. But there's a problem with it, and that's in the continued claims data. Continued claims, a proxy for the number of people receiving benefits, were little changed at 1.96 million in the previous week. And this is a major problem for the economy, because what it's telling us is that people are on unemployment, cannot find a new job. They're getting stuck on unemployment longer. And we know the data is very clear about this. The longer someone is on unemployment, the more their spending goes down. So when we step back and look at the economy, what do we see in the survey data? Those who have a job are worried about losing it because they see their friends and family who are on unemployment can't find another job. And so that uncertainty, that financial fear, leads to less consumption. And that's a dangerous sign, because if something doesn't change in the economy, well, the risk is that low number in initial claims is going to shoot a whole lot higher. Let's take a look at continued claims in blue against initial claims in red, and you can see very clearly the impact of people on long-term unemployment. Their spending power declines that affects other people in the economy, and next thing you know, rising continued claims pulls initial claims higher, and then we head right into a recession. And you can see that throughout every cycle except this current one, because initial claims are remaining at a very low level while continued claims continue to tick higher. So as we talk about the risk for the economy right now, we're very clearly seeing cracks. The question is, will it spiral out of control? Well, as we turn to look at the non-seasonally adjusted data, there's some evidence that we're headed in the wrong direction. Because we can see, looking back in July 5th, we broke that 2 million mark. That I said was a line in the sand, where I thought if continued claims get over that number, it starts to spiral out of control. Last week, we saw it increase 4,500, now just over 2.016 million. And again, the risk is it's going the wrong direction. So the question is, will rate cuts spur consumption? Will it be enough to drive demand and cause employers to hire? Well, history says it doesn't work that way at all, which is why I said, as you're about to see, this move by President Trump, I think it's too late. Let's take a look now at continued claims overlaid against the federal funds rate in red. And you can see the Fed reacts to the labor market. Let's go back through every cycle. You see a rise in continued claims, the Fed's cutting rates, and what happens? It has absolutely no effect on the labor market. In fact, it seems like it accelerates the decline in the economy and sends us right into recession. And let's look at the current cycle, because the Fed did cut rates, and you can see it had virtually no impact on the labor market at all. So the notion that we get some more rate cuts here and that all of a sudden consumers would flood out and buy homes and cars, and the savings on their credit cards would lead to further discretionary spending, there's absolutely no evidence of it. But as we look to the U.S. economy, because remember I said it's continuing to slow down, well, the evidence is we hit a plateau, and it's likely to get worse as summer comes to an end. Let's turn to American Airlines as falls on raising doubts about U.S. travel rebound. And this is a major issue because July has been a tough month because of domestic consumer weakness. Now, I want you to understand that about 2/3 of American Airlines revenue comes from domestic travel. So this is a clear sign that it's not about interest rates, not about the tax cuts, not about the trade war. It's actually about the economy and the trajectory that it's headed on. For most Americans, it's on the wrong path. An American says the reason behind this is travelers continue to grapple with uncertainty about the economy. No, it's because the economy is going in the wrong direction. In fact, even the evidence shows up in corporate travel. Demand there is flat as well. And again, you talk about the issues here that a lot of these airlines are facing, and there are some trade war effects here because you talk about the Brazilian tariffs, which are set about 50% right now. Keep in mind, a lot of airlines run Brazilian-made airplanes. They're citing that the cost just to get parts is going to go way up, and it could cost the servicing amount of these airplanes to go up to as much as $9 million per year. So as we see demand continuing to drop off, the issue is costs are going up. It's going to squeeze the profits of airlines, meaning they're going to be forced to raise prices. Problem is, we're already seeing signs that consumers are rejecting higher prices, and for good reason. Again, it's about the labor market here. Let's take a look at the consumer price index for airline fares against average weekly hours of production, non-supervisory employees in red, and you can see very clearly when paychecks shrink, travel goes down. That's what we're seeing in the economy, and look at where we're at now. We know that airline fares are going to come down. We know capacity there is going to go up. It's all because hours worked are moving to the downside. And carriers have been forced to trim ticket prices this summer in an effort to fill planes as flying capacity surpassed demand. American is among those trimming growth in the second half in an effort to tighten supply and boost fares. And so what does that mean, of course, for people who work in the airline industry? It means jobs are going to be lost. It means hours are going to get cut, and that means spending is going to go down. And it's not just American, also Southwest said it would cut flights during off-peak periods as carriers grapple with weaker domestic travel demand than expected at the start of the year. More discount in the summer, they said, which is generally the busiest travel period of the year. And we've heard from airlines saying, look, if things don't turn around by mid-August, we're going to cut a lot more flights. We're going to bring capacity down. And again, it's going to put a lot of people on the unemployment line. But it's not just airlines that are seeing a drop in demand. It's also the restaurant industry. We get this news from Chipotle today, where we see Chipotle stock tumbles 9% after chain cuts same-store sales forecast. As average check increased roughly 1%, partially offsetting traffic declines of 4.9%. Again, clear evidence that as prices go up, consumers are rejecting them. Now, the question is, will rate cuts spur people to go out and buy a burrito? Well, Chipotle says it might, because they say that concerns about the economy led consumers to skip restaurant visits and save their money instead. Again, it's not about saving money. Consumers are being squeezed financially, particularly over the summer. As we know, utility bills have been skyrocketing. Consumers can't afford to eat out at the way they're used to. But problem for Chipotle, and what it's going to be for a lot of businesses going forward, is they're going to be affected by the tariffs as well. Chipotle said they see their costs going up by 20 basis points in the coming quarter, 50 basis points after that. There's going to be no end in sight. But another company who's being impacted by the tariffs and a cut of tax credits, well, that's Tesla. And they're bracing for a rough quarter as the U.S. ends EV incentives. Right now, Musk is blaming a tough economy as revenue fell 12% to $22.5 billion. This is a little over $42,000 per car, the now steepest decline since 2012. Vehicle delivery slump and the average selling price of Tesla cars dropped. And what this has done is it's tanked Tesla's margins down to 4.1%. And we've talked about the effects of this as margins go down and demand goes down. Employers are going to be forced to lay off. Let's take a look at this next chart of domestic auto production shown in blue against average weekly hours of production and non-supervisory employees in red. Then you can see very clearly as hours work go down and paychecks shrink, demand for automobiles goes right along with it. So you can see President Trump wants a tax cut to spur domestic auto sales. It's not likely to work. And Tesla is very clear evidence of this because they delivered a little over 384,000 vehicles. That was down 13.5% from the previous year. The problem is their production was a little over 410,000 vehicles, meaning they're building inventory here. But when we talk about the labor market, the real issue here is capacity goes down, demand goes down at the factory level. What it means is demand for employees goes right along with it. So looking back to the beginning of the show, I asked the question, is Trump's unheard of move, is it politically motivated or is it economically motivated? And the answer is it's all about the economy. We're seeing the tax cuts not moving the needle here. The trade war isn't really spurring a lot of domestic demand for workers. Even a stock market at all-time high isn't causing a surge in demand. What we're seeing is very clear signs. There's cracks in the labor market. Demand is continuing to slow. The ultimate question is, will rate cuts fill that gap? Well, I don't think it will, and that's why I said in the beginning, I think it's too late. But something we're bullish on that's not too late to get in on, and that is a stock for our sponsor for today's show, CyberCatch Holdings. Again, you can find them on the TXXV and the symbol CYBE, and on the OTCQB and the symbol CYBHF. Everything you need to know in the pinned comment and description below. Because they're a cybersecurity innovator delivering an AI-powered SaaS platform for continuous compliance and risk mitigation. They tackle security holes that cause cyber attacks across industries. Its cutting-edge approach is transforming cybersecurity for businesses worldwide. And cyber attacks are surging, with healthcare facing 734 data breaches in 2024 alone, averaging 9.77 million per incident. CyberCatch's platform identifies and fixes security vulnerabilities that cyber criminals exploit. It's a critical solution for industries like healthcare, defense, and even crypto. And CyberCatch's patented AI-enabled platform tests cybersecurity controls in 3 dimensions, enhanced by its acceptance into the NVIDIA Inception program in June of this year. This AI-driven approach ensures robust protection by identifying and fixing vulnerabilities. It's a game changer for organizations seeking continuous compliance. And in July, CyberCatch launched its HIPAA Compliance Manager, helping 600,000 U.S. healthcare providers achieve compliance and secure no-application cyber insurance. This AI-powered solution addresses the healthcare sector's cyber attack epidemic with automated risk mitigation. It's tailored for medical practices, hospitals, and clinics. And CyberCatch's CCMC Compliance Manager launched in July of this year as well, supporting 80,000 U.S. defense contractors with 2.0 compliance, while a CSS Compliance Manager protects crypto platforms from massive cyber threats. Both solutions offer compliance and discounted cyber insurance, showcasing CyberCatch's industry versatility. It's a vital tool for high-risk sectors. And CyberCatch saw a 42% customer increase in July of last year and is partnered with CMR Risk and Insurance in February of this year to offer no application cyber insurance at discounted premiums. Serving healthcare, defense, and retail, its AI platform is gaining traction globally. The company is poised for significant growth in critical markets, including what we're seeing in their stock chart. And you can see their stock is riding a rising channel higher. Here recently pulled back to the bottom end of the channel where it found buyers, setting up a move to the top end of the channel where it could break out from there on rising momentum. And discover CyberCatch's cutting-edge cybersecurity solutions and stay up to date on the future of cyber safety at cybercatch.com. And be sure to follow them on the TSXV under symbol CYBE and on the OTCQB under symbol CYBHF. And as always with any company we feature on the show, you're under no obligation to purchase their stock. Be sure to do research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.